We're now lucky enough to have Hayley here. So Hayley will be taking us through the joyous interaction between 17 and 9. So for all of you who thought that maybe some of you that 9 was gone and behind you, Hayley is going to rain on your parade. So Hayley, thank you.
Thank you. I'm not sure what I did to get the slot before morning tea and also the last slot of the day on two very technical topics. So thank you very much for that. Really appreciate that.
You're always a sucker for punishment.
I am.
So
I definitely am. So look, very happy to be here today. If you are falling asleep, I know it's been quite a heavy morning. The first thing I would say is all I want you to get out of this session is that this session is about opportunity. You have an opportunity here to take two very complex topics, but to align them for your organisation so that the profile in the future of your financial statements is effectively where you'd like it to be. There is a lot of requirements in these standards. There's a lot of work to be done, but this is an area where the IASB has effectively appreciated that there is a lot of complexity, there's a lot of choices to be made, and really given you some options to make sure that you're aligning these two different standards wherever possible to get the profile that you're looking for in your financial statements. What we have here is a bit of a timeline around IFRS 9 and IFRS 17. So IFRS 9 was obviously effective back in 2018. However, the standard setters have come out with some options to actually defer the standard until the adoption of IFRS 17. The first question I would like to ask, so you can use your legs to stand up or you can use your arms and put them up, is anybody in the room know, has their organisation already adopted IFRS 9? Very low hands. So a couple of you actually had, but that's probably where I would expect. So if your organisation hasn't adopted IFRS 9 and is waiting for IFRS 17 under the deferral option, can you put up your hand? And the rest of you have no idea, is that? Probably want to figure that out. So as I was saying, IFRS 9, there is an option to defer that until the adoption of IFRS 17 for the exact reason that I spoke about, the opportunity to align the two standards. You can only do that, or you can only take that deferral option if you meet a test around your predominant activities within your organisation. And that test effectively works at looking at your liabilities and saying, are 90% of those related to insurance activities? Obviously, if they're not, if the organisation is doing a range of other activities, and IFRS 9 is clearly important for those, such as, let's say, funds or any kind of banking, well then clearly the standard setters don't want you to be delaying the adoption of IFRS 9 and using IFRS 17 as an excuse. There is another option that you will hear about pre-adoption of IFRS 17 called the overlay option. That is not relevant here in Australia because 1023 and 1038 already require you to hold all of your assets at fair value through profit and loss. Probably just one more question. So obviously 1023, 1038 requiring assets that back insurance contracts to be held at fair value through profit and loss. Shareholder assets, other assets could potentially not be applying that model, but in my experience, I actually haven't seen anyone use anything other than fair value through profit and loss. So is there anyone in this room that has assets that are not held at fair value through profit and loss? Under 39. All right, let's go with a no on that one. So so I guess the outcome from that, we'd expect the majority of you would be applying the deferral option, would be waiting until you adopt IFRS 17 to adopt IFRS 9 at the same time. So again, that's where a lot of the opportunity comes from. For those of you that have already adopted IFRS 9, there is still an opportunity because you have the ability to reassess any decisions that have already been made. Effectively, the first interplay between IFRS 9 and IFRS 17 is, well, what standard do you apply at all? Here in Australia, we don't expect that there is going to be a great amount of contracts that were previously recognised as insurance contracts and now should be recognised under IFRS 9, and that's because the definition of what is an insurance contract under IFRS 4 and IFRS 17 isn't really changing substantially. That said, I just want to put a bit of a practical overlay on this. This is really, again, an opportunity to reassess or, let's say, correct anything that may have not been assessed appropriately in the past. So effectively, if you had an insurance contract in the past, it was defined as an insurance contract, you're applying the old standards, but there was, let's say, an embedded derivative contract that was kind of ignored. This is an opportunity to now reassess that. So let's say if there was death or other benefits that were linked to an equity price feature within an insurance contract, this decision tree shows that really this is another opportunity to be going through those insurance contracts, determining all of the features within those contracts and whether they should be separated out and falling under another standard. Now, I am an audit partner, so I appreciate that there's some sensitivity around that, but this is an opportunity to be reassessing the way that things have previously been done. So what I wanted to do was just give you a little bit of a refresher on IFRS 9, and particularly for those of you that haven't adopted IFRS 9, or some of you might not even know what it is, given some of the blank faces I got in the audience before. This is a bit of an opportunity to say, well, what does that actually standard require, and therefore how could it potentially impact my organisation in the future? So IFRS 9 is effectively split into three parts: classification and measurement, impairment for those assets that are classified at amortised cost, and hedge accounting. Classification and measurement is obviously the key one. So historically, where all of your assets have been held at fair value through profit and loss, on adoption of IFRS 9, there needs to be a process to actually go through those assets and determine, well, actually, how should they be classified under the new IFRS 9 standard. In terms of financial liabilities, not very much is changing, so we can probably ignore that. In terms of financial assets, effectively what the standard requires is that financial assets are split into three categories. You've got equity, you've got derivatives, and you've got debt. So your debt would be, for example, your bond portfolio. Equity instruments that are held for trading will be held at fair value through profit and loss. Those that are not held for trading, that are held for the long term, so this might be an old available for sale portfolio. Under the new standard, they can generally get into a category called fair value through OCI. So that is really quite an important category, because under the past, if you had investments as available for sale and you were taking all of the fair value movements on those through other comprehensive income, if you had an impairment on those, or if you had a realisation of those, that amount would flick back through your P&L. Under the new standard, that's not the case for equity portfolios. Realised gains and losses on those will always stay in OCI. So that really is quite important, again, in determining your profile and your matching against IFRS 17 and your movements in IFRS 17, because if you have a large equity portfolio, you might be under the desire to actually hold that at fair value through profit and loss, not for fair value through OCI. Derivatives continue to be held at fair value through profit and loss. Debt, there's a number of tests that you actually need to go through to determine where that debt or that bond portfolio that you're holding actually falls. There's two tests. The first one is the contractual cash flow test. So that says, am I holding this instrument only for the receipt of principal and interest? So am I just holding this bond for the returns that I'm going to make for it, or is there any other feature? So generally, with a vanilla bond portfolio, you would pass this test. The second test is, why am I holding this portfolio? Am I holding this for the long term, just to retain the cash flows, or am I actually holding this in a model to sell? Am I holding this for fair value purposes? For example, a liquidity portfolio, which I'm sure is quite common to many of you. And therefore, as a result of these two tests, can I hold this instrument at amortised cost, at fair value through OCI, with recycling in this case, so impairments do come back through your P&L, and then, or the other option is, am I holding it for more trading purposes, and then it would be at fair value through profit and loss. So there's obviously a lot of tests to go through, and this is all of the underlying work, and why I can't answer all your questions today, because it's really understanding each of your individual portfolios and what the actual assets are that you hold and how these need to be classified under the new standard. Now, this is the scary bit. So if you hold an asset, let's say a debt asset, that meets the criteria for amortised cost, or more likely, I would say in your scenario, is fair value through OCI, so that's a bond portfolio that you're just holding for liquidity purposes, you actually need to apply the new impairment model under IFRS 9. Now, there's no bankers in the room, I expect, but if you were to talk to one, they would tell you about how fabulous this standard is and how much work it's created for them over the last few years. Effectively, what this impairment model does is it moves from an incurred loss model to an expected loss model. So there's a lot more judgment involved around measuring the expected losses on your portfolio, and determining, I guess, what the expected credit losses are that you are going to have on your portfolio. There's a lot of operational complexity around the models, the methodology, et cetera, that you're actually using, the probabilities of default, the loss given default. I know these are quite complex terms. All I really want you to get out of this is that if you get into a category of fair value through OCI or amortised cost, this new impairment model is something that you need to think about. So when we talk a little bit later about some of the benefits of using these other categorisations other than fair value through profit and loss, or you might be in this situation where you have to use these categorisations because of the way that your business model actually works, then this standard is going to come into play, this part of the standard. So, alignment between IFRS 17 and IFRS 9, and why is this actually relevant? So you can see here what this slide is really trying to get out is that both of the standards have different objectives, and your job is really going to be to align the two of them to get the profile that you want on your balance sheet. So just as a bit of a practical example, I have a client that is very concerned, an insurance client that is very concerned about interest rate volatility. So they actually would like to use the fair value through OCI categorisation for their bond portfolio because they want to be stripping that interest rate volatility out of the face of the profit and loss. So absolutely key, I guess, as I've spoken about, is going to be minimising the accounting mismatches between the assets and liabilities. I think key is the middle dot point there, you know, which gives an example around, you know, the current rate, under the new standard, you sort of have some options in terms of discount rates on your insurance liabilities and how you can disaggregate those between fair value through profit and loss and through OCI. So again, it's around looking at your, your portfolios of assets and liabilities and your contracts and aligning those so that the profile that comes out in your financial statements is as aligned as it possibly could be. Because you don't want to be in this situation where you're creating volatility because you haven't made some accounting policy choices which give your organisation the best profile that it can have. Coming back to an earlier point that I raised around the definition of insurance contract, being the same as I guess it has historically been. This standard comes again back to that point around disaggregating that contract where there's other components. So that where there's any embedded derivative features, and then they need to fall under the IFRS 9 standard. Whether there is any distinct features within the contract. Don't expect that would be too common here in Australia. We more expect non-distinct features. But all this standard is trying to get across is that you're taking each portion of the contract, splitting out and determining which standard does it actually fall under. So, for those of you that already have adopted IFRS 9, you will be in the second what's this hand? The hand of the slide. For those that haven't previously applied IFRS 9, you'll be in the right hand of the slide. So basically what it's saying for those of you that have already previously adopted is on adoption of 17, you actually get the option to reclassify, to revoke any designation or choices that have already been made on adoption. So I think what's probably happened is, as most of you work through IFRS 17, you probably haven't put too much thought into IFRS 9. I certainly wouldn't, and have thought, well, look, everything was under fair value through profit and loss in the past. Let's just keep those categorisations and move that forward under the new standard. Whereas, as I'm saying, this is now the opportunity to reconsider any of those designations for the profile that we were just talking about. For those of you that obviously haven't applied IFRS 9, again, this is the opportunity to be going through each of your portfolios, understanding exactly what's in them, going through all of those tests in terms of categorisation. Now, there is one slight problem with this, and that's really in relation to comparatives on adoption. So IFRS 17 obviously relies on comparative information and adjustments through equity or retained earnings. IFRS 9 has some rules around adoption and use of hindsight and when you can actually adjust comparatives. So on adoption of IFRS 9, for example, most organisations, you know, the banks, the asset managers, etc., they didn't actually adjust comparatives. They took a one-off adjustment through retained earnings. So that's going to be absolutely key, because does that mean on day one of adoption of the two standards, are you actually going to effectively create a mismatch in that? And then how are you going to deal with that going forward? Are you going to make additional disclosures to explain this was a one-off adoption issue or not? Again, it will all depend on the classifications that you choose, the profile that you're looking for, and whether there are any changes from, you know, fair value through profit and loss under into IFRS 9. Now, there is some discussions later. I know two of my colleagues from EY are coming to talk about systems data processes. However, this slide is sort of just giving you the practical implications of everything that I said. Basically saying, do not just assume that IFRS 9 is another problem for another day. Embed it into your IFRS 17 project to make sure that you're actually considering it at the same time that you're considering the profile that is going to result from your adoption of IFRS 17, to make sure, again, that you can align the two. I'm talking later on today about disclosures, and the data requirements for both of these standards are really quite significant to be able to make sure that you get to the disclosures that you need to get to. So really making sure that you're embedding in the program, embedding in your underlying program, involving your IT colleagues, involving the actuaries as needed, and really considering the multi-scenario approach of, if I make this choice, this is the outcome. If I make this choice, this is the different outcome. Because you certainly don't want to be sitting in a situation where you're getting questions on volatility that you don't necessarily need to have. Once you've made these elections under IFRS 9, it's almost impossible to get out of them. So don't make them too late with not enough thought and then be left in a scenario where people are questioning the choices, the accounting policy choices that have been made. Thank you.
So you did scare a lot of people off, Hayley, but there's still, don't run away yet, don't run away. Hayley, don't run away. There were some questions, even though it was fairly comprehensive. Unsurprisingly, if we pull up Slido, there's three that I've sort of kept that are in there. Oh, gosh. And look, you can be... I'll read them out.
Oh, yes, it is a lot of work.
When should they start? I saw the lovely diagram that you had, but there was no timeline on there. You left blank. Should people have started yesterday, last year? Is it too late? Should they be crying?
You have to be realistic, right? So, the thing is, in life insurance, I think if you haven't started, probably got some issues now. In general insurance, I think the reality is that most people have said, we've had a year delay in IFRS 17, we've got another year to ignore the standard, and look, that is just reality. You need to be starting now. I think for those of you that haven't, setting up project teams is absolutely key now. And as I was saying, now that you probably understand the ramifications of the two standards, making sure that you're setting up a project team that considers IFRS 17 and IFRS 9 at the same time. It could be more simple. If you're in the scenario that, actually you've considered fair value through profit and loss and it works within the parameters of all the tests that need to be undertaken, then IFRS 9 is probably going to be simpler. But it's about doing that work, doing that diagnostic, that gap analysis up front. What do we actually have? How is it actually going to be impacted by those standards? And doing that now is going to be absolutely key.
The second one's about data availability. The person ends the sentence with help, so that sounds interesting. I know under 9 there is sort of I think there's an opt-out or a transition relief, which is sort of undue cost or effort.
Yep.
What are you seeing, Hayley, in your clients in terms of, data that the standards are now asking people to have and at a certain granular level just isn't available in the current business?
Look, it just isn't available, and that's where internal discussions around what can we get, what's the absolute best that we can actually do. Looking to industry data if possible, making friends with people on the table around you so that you can try and draw comparisons of data. But look, when the banking community, and Jeff, as well as I did, adopted IFRS 9, it was the exact same problem. They had no historical data, and it was really about taking a best of what we can possibly get. But again, if you're not thinking about data now and you're waiting a couple years, then you're going to be in more trouble if you're thinking about it now. Getting on top of these things now, particularly if you need an impairment model, right? So thinking about it now and what is best used, what did others use on adoption, what did the small credit unions use on adoption of IFRS 9, looking at those things now is going to be absolutely key.
And the last one, Hayley, is the difference between all the benefits of considering APRA capital requirements and classification versus accounting. I know the banking community had some interesting dilemmas around the differences or the comparability. Is there anything you wanted to share with the audience
I would say that's a question for APRA, aren't they here? Look,
Save it up.
You're not always going to get an alignment between the two. I often get these questions around, well, what does APRA expect? You have financial reporting and you have capital requirements. Sometimes they align and sometimes they don't. So, it's a difficult one to answer.
Thank you, Hayley.